Good morning. Welcome to Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me is Robert Yawger. He's the senior energy analyst over at Mizuho Americas. Robert, it's been a while since we caught up, and there's a lot that's happened in the market, particularly, let's talk crude, from the January 25th three-year high of 66.66 into where we are now, hovering around $60 a barrel. It seems to be that 666 is a big number in the major averages.
Yes, it was a big number. It was a number, we got there because of the OPEC production cuts. We also got there because the speculative community really loaded up on the long position. They got to an all-time record, which pushed it to those levels on the back of the OPEC deal. Since then, though, with that in mind, we have had a storage situation here in the United States where last week the domestic production number went through 10 million barrels a day for the first time in the modern era. And it went through quickly. It gained 300,000 barrels last week. So it went through with an exclamation point. The correlation to equity markets, which were under pressure, that put pressure on the energy market too, and we were down 12% last week, basically, as a result of that.
How concerned are you with the rise in supplies? Because it seemed as if that $40 to $50, perhaps $50 range was where crude was appropriately priced, and then had that run up along with the rest of the market. But the fact of the matter is it's on supply and demand, and supplies are at record highs again.
They are. But demand is good also. We do have a strong global demand situation out there, and you do have the OPEC situation too. So while I do think that this pullback is well-deserved, the market was extended. Some of the momentum indicators that tell you if the market's underbought or overbought were well overbought. However, there are plenty of reasons to be confident that we're not going to slide off the face of the earth and get to those numbers that we had been in 15, 16. So It's a pretty good demand situation at the end of the day. It's actually a pretty good market situation. We were just really extending the upside to levels where it didn't necessarily belong. So a correction in the equity markets that we had is also reflects in the energy and the oil market too, in my opinion.
All right, let's talk about the natural gas market, because we're coming towards the end of the winter drawdown season. How did it perform through this winter?
Well, it's a good thing I'm here now, not 2 weeks ago, because 2 weeks ago, just 2 weeks ago, natural gas was really looking strong, and it traded into the 360s. When the February contract went off, though, there was a 47-cent gap between February contract and March contract. That's the beauty or the hatred of the futures markets. You can have those kind of gaps. So we settled at 350 in February, but the next contract, March, was automatically 303 the next day, 47 cents lower just on the rollover. So that really started to spook folks. That was the same situation there to a certain degree. The speculative community was loaded up on natural gas, around 200,000 contracts, big position for natural gas. And that market started to come off quickly. Not only that, but the weather forecast went from, remember a couple weeks ago, really cold. And we had a draw of over 300 BCF in one of our storage reports to now it's warm. And we're averaging them on many days 10 to 15 degrees above normal in natural gas. People thought that we'd end the winter season about 1.1 to 1.3 TCF above up for total by the end of the year. Now that this warm weather is rolled into the area, they've had to adjust their expectations. And now we're looking at something along the lines of 1.5 to 1.7 at the end of the season. And you're seeing many of the traders adjust their positions accordingly, and that's putting pressure on the natural gas market strong here. The natural gas market has switched in the front of the curve from backwardation to contango.
Right.
That's a very negative price structure. That means the front month is cheaper than the second month, and then the rest of the curve. That's not good, and that happened on Friday.
How have energy stocks been performing through earnings season outside of the underlying commodity movement that we've seen?
Well, the matchup coming into today is last week, energy, the S&P energy names were down 14%. Crude oil was down 12%. So and crude oil was the worst performing sector in the S&P 500 last week. Now that's the cold numbers right there. But the numbers have been, it's a mixture. Chevron and ExxonMobil, who are Dow components, they really did not meet expectations. BP, on the other hand, did. And some of the smaller folks have done well also. You have like Anadarko has been doing okay. Some of the refiners have done okay. So, then we have some of the refiners that didn't, on the other hand, which is hard to imagine because they were, the crude oil is relatively cheap. You send it through the refinery, you make relatively expensive gasoline. The relationship between gasoline and crude oil has been very strong relative to last year and the year before. And a couple of refiners have done well in that environment, a couple haven't. So it's Sometimes it matters how close your center of your activity is, as to, for example, in Cushing, where the largest storage facility in the United States. It's also what the NYMEX is priced over, the crude oil barrel. But it runs at like a $5, it has been running at a $5 discount to crude oil that's available on the Gulf Coast. It runs at a $5 discount to crude oil on the international market. So if you have operations close to Cushing, you can get it $5 cheaper, you're going to do well. If you're not, you kind of don't do as well.
All right, and to wrap up, I realize we're only 6-7 weeks into the year, but what's your outlook for 2018? What are the key catalysts that you're looking for within the energy space?
The big thing, the shorter term, is going to be the Fed meeting in March, in my opinion. If interest rates continue to rally up, in my opinion, that's what's putting pressure on risk assets at the moment. If that becomes a situation where the market feels more comfortable after that's over, you'll probably start to see the weakening of the dollar or stronger crude oil, stronger commodity markets. Another big date is going to be in June when OPEC reevaluates the situation there. There's a little bit of pressure by Russia, it seems, to kind of unleash the tap, open the taps, give the Russian oil companies the ability to move more barrels than they are already. There'll be a lot of comments coming out at that point, going in and coming out. If there's an official kind of statement, announcement, whatever, that they are going to start to try and wrap up the OPEC deal, that would be a major development in the energy market. And I think that's probably the biggest that's the biggest event of the year.
All right. Well, thank you very much for joining us today. And traders, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.